Good morning. My name is Myron Frans, Commissioner of Minnesota Management and Budget. I have with me today Dr. Kalombokidis, the State Economist, and Britta, Reitan, the State Budget Director. As the legislature begins its new session several weeks ago, today we're here to present the February forecast, which is reflective of current law. This forecast includes revenue and spending changes as well as economic changes from the last forecast that we delivered in December. MMB's forecast documents are available online at mn.gov/MMB under the Forecasts and Updates tab. The good news for Minnesotans, is our budget outlook remains stable. Yeah, I don't usually boom quite that much. I bellow, but I don't boom. Perfect, thank you. The good news for Minnesotans is our budget outlook remains stable, and the really good news for all of you here today is that this means a shorter press conference. The forecasted balance for fiscal years 2021 is $1.513 billion. That is an increase of $181 million since November. We raised the revenue forecast by $96 million, and we lowered the spending forecast by $91 million. In addition, we raised the stadium reserve projection $6 million. The change in spending and revenue each represent 0.2% change from the November forecast. Later, Budget Director Reitan will explain more of the math and expenditure changes. As I mentioned in December, we reached our budget reserve target, and this milestone continues in today's forecast. A budget reserve is not only an important element of Minnesota's preparation for an economic downturn, it is also a key credit factor that rating agencies use to determine fiscal or financial stability in awarding Minnesota our AAA credit ratings. Rating agencies want to be sure that states can weather an economic downturn, and a full rainy day fund is a strong positive indicator. Structural balance also continues in this forecast through fiscal years 22 and 23. Remember, structural balance exists when projected revenue exceeds projected spending within a biennium. In this forecast, the economic outlook for the state remains stable. However, budget challenges exist, and as always, there are risks with every forecast. I'd like to turn it over now to Dr. Kalombokidis, who will describe the economic outlook and how it's changed since December.
Thank you. Hello, everyone. I will start by talking about the U.S. outlook the outlook for the U.S. economy and how that has changed since we last produced a forecast. I'll then move to Minnesota's economy, and finally to the changes in our revenue forecast. The chart that you have in front of you now compares the current U.S. real GDP forecast by Minnesota's macroeconomic consulting firm, IHS, to their prior forecast. The dark bars show the history and their February 2020 outlook, the one that informs our forecast, and the light bars show their November 19 forecast. Focusing on years 2019 to 23, you can see that the outlook for U.S. economic growth has changed very little since our forecast was last prepared in November. Only in 2022 is the growth forecast slightly higher than before. And the pattern of slowing growth through our planning horizon carries over from the prior forecast. IHS expects current economic conditions to support moderate real GDP growth of 2.1% this year. In particular, consumer spending constitutes about 2/3 of real GDP, and IHS expects consumers to remain the primary contributors to growth in the economy. In this forecast, consumer spending growth is supported by rising incomes, falling gas prices, a lower interest rate path, and rising household wealth. When wealth grows, for example, from rising home values or rising financial asset values, consumers tend to spend more. That positive wealth effect has been an important contributor to economic growth during this expansion. But it is at risk if wealth declines or if economic and policy uncertainty make consumers jittery. Looking at the shortening dark bars for years 21 to 23, you can see that a slowdown is still expected, and it starts late next year. Real GDP growth is expected to decelerate from 2% annually in 21 to 1.5% in 23. The slowdown occurs as the contribution to growth from federal fiscal stimulus declines. Lingering effects of tariffs and trade policy uncertainty undermine business investment. Interest rates gradually rise, and growth in household wealth slows. In addition, a decline in the U.S. labor force participation rate due to an aging workforce will further slow the economy. While there's little forecast change overall, underlying the GDP forecast is lower expected growth in some types of consumer spending. Lower forecasts in those components bring down our forecast for sales tax revenue, which I'll talk about in a moment. This chart compares Minnesota's labor market performance to the nation's. The chart shows the headline unemployment rate. The dark line is for Minnesota and the light line is for the United States. The vertical gray bars are the U.S. recessions, so the white space between the bars represents the recovery and expansion periods. Throughout the current expansion, now in its 11th year, Minnesota has continued to add jobs and sustain an unemployment rate below the U.S. rate. However, Minnesota's pace of employment growth has slowed, and the gap between the state and national unemployment rates has narrowed. The U.S. unemployment rate is at a 50-year low of 3.5%, while Minnesota's rate has gradually risen since December 18 to 3.3%. This increase, along with a decline in the U.S. rate, has narrowed the gap between the national and state unemployment rates. The increase in Minnesota's unemployment rate coincides with an increase in our labor force participation rate, which is the share of the over 16 population that is either working or looking for work. Our labor force participation is consistently well above the U.S. rate and among the highest in the nation. But since December 18, it is inched even higher to reach 7.3%, which is 7 percentage points above the U.S. rate and the second highest among U.S. states. Coincidental upticks in the labor force participation and unemployment rates suggest that some new workforce entrants may not have immediately found work. Creative efforts to match them to jobs will lower our unemployment rate and support overall employment growth. Demand for labor in Minnesota is strong, and we expect that demand to persist as long as the U.S. expansion does. But baby boomer retirements have made it difficult to match that demand with increased labor supply. Job vacancies statewide have grown to a very high level. For the last 2.5 years, the ratio of unemployed persons to job vacancies has been less than 1, meaning there are fewer unemployed job seekers than open positions across the state. And that condition is true both in the metro and in greater Minnesota. At the low point of the 07-09 recession, there were nearly 7 unemployed persons for each job opening in Minnesota. In contrast, there are now 7 people for each 10 job openings. Amid that strong demand for workers, slower labor force growth appears to be limiting the state's ability to add jobs. Between 2011 and 2017, Minnesota added an average of 43,000 jobs per year. In the last 2 years, the annual additions have averaged about half that number. In this forecast, we expect slower employment growth to persist, as growth in total wage and salary income in Minnesota will primarily come from higher wages per worker instead of from larger numbers of people employed. Moving to the revenue forecast, total general fund revenues for the current biennium are now forecast to be $96 million, 0.2% more than the November forecast. Higher expected corporate tax revenues more than offset lower forecasts for the income and sales taxes. Individual income tax receipts are now forecast to be $51 million less than the November forecast. The decrease is primarily due to lower forecast growth in both wage and salary income and non-wage income. General sales tax revenue in FY 2021 is now forecast to be $81 million less than the prior forecast. This change reflects a lower forecast of taxable sales, including some of the components of consumer spending that were lowered in the U.S. outlook. The corporate franchise tax is forecast to generate $217 million more in the current biennium than the prior forecast. So far in FY 20, gross corporate tax receipts have exceeded our November 19 forecast by $59 million. So that larger base of collections, the larger collections drives an increase in the forecast for corporate tax receipts for the remainder of the biennium. Let me conclude by drawing your attention to some of the risks to the forecast. I mentioned the risk that consumers, the champions of this economic expansion, get spooked by uncertainty or negative wealth effects, for example, from a prolonged decline in the stock market, and hold on to their wallets. This forecast incorporates all U.S. tariffs and other countries' retaliatory measures that have been put in place to date, as well as the tariff rollbacks in the recent Phase 1 trade deal agreement with China. But as you know, U.S. trade policy, especially regarding China, but also with regard to our other trading partners, has been in flux. Uncertainty imposes costs on businesses that must address supply chain disruptions. Businesses appear to have put investment plans on hold, and prolonged uncertainty will exacerbate the slowdown. On the other hand, a boost to business investment from alleviation of trade policy uncertainty is a source of upside potential in this forecast. In their February outlook, which they released on February 6th, IHS expects temporary and modest impacts on the U.S. economy from COVID-19, the disease caused by the new coronavirus. They noted last week that U.S. economic fundamentals remain healthy, and the economic impacts in the U.S. from the outbreak are still expected to be modest in the context of the very large U.S. economy. However, every day brings new understanding of the public health effects of the disease, and the economic impacts remain uncertain. If the impact of the outbreak becomes more prolonged or widespread than it appeared at the time IHS constructed their February outlook, U.S. economic growth could be slower than forecast. The economic effects of COVID-19, whether they're temporary or sustained, could come through any of several channels. Demand for U.S. goods exported to China and other Asian countries, including agricultural commodities, can fall as economic activity slows in that region. U.S. manufacturers that import intermediate goods from Asia must adapt to supply chain disruptions. And U.S. consumers may spend less as uncertainty increases and financial market volatility dampens growth in household wealth. Finally, with 16 months before the end of the current biennium, even small changes to assumed growth rates in particularly volatile income sources, such as capital gains or corporate profits, could materially alter the budget picture through our planning horizon. I'll now turn it over to Budget Director Britta Reitan.
Good morning. I'll turn to the expenditure side of the forecast. The expenditure side of the forecast shows a relatively small amount of change since the November estimate, an overall reduction of spending of just $91 million, which is a 0.2% change compared to prior estimates. Spending in E12 education is the biggest driver of this change, with projections $99 million below November estimates. And this change is largely due to a reduction in student projections from previous estimates. Final data for the 18-19 school year was reported in December, and these numbers came in below prior projections by about 0.3%. Total student numbers are still growing year over year, but at a slightly slower pace than previously forecast. This change in student counts resulted in a $56 million reduction in the basic aid formula in the current biennium. Additionally, compensatory aid projections are also lower when compared to the previous forecast by $8 million. And compensatory aid is based on the number of free and reduced lunch count students, as well as the concentration of those students. So the overall change in student numbers affects that as well. Additionally, there is a $29 million reduction in special education spending estimates due both to lower total student estimates and a slightly slower projected rate of growth in the actual expenditures for special education services. The changes in all other areas of the expenditure forecast slightly offset the change in E12 education and are negligible relative to the November estimates, leaving us with a total spending change of $91 million. Moving to the next slide, this brings together the overall picture for fiscal years 20 and 21. The slide compares our November forecast estimate with the February forecast estimate. At the bottom of the first column, you can see the budgetary balance that we were projecting with our November forecast of $1.332 billion. The projected balance has grown with this forecast by $181 million to $1.513 billion. Again, that 181 million change is due to a relatively small increase in our revenue projections of 96 million and a small decrease in our spending projections of 91 million. The overall change also includes an additional $6 million that is allocated to the stadium reserve. It's also important to note that a large portion of the budgetary balance in fiscal years 20 and 21 is actually due to money carrying forward from the 18-19 biennium into 2021. About $1.1 billion of the $1.513 billion balance is due to funds carrying forward from the prior biennium, and that will be clearer on the next slide. So this slide provides another way to look at the impact of the carry forward from fiscal year 18-19 into 2021. The slide shows our structural balance in both 2021 and 22-23, and 22-23 is what we refer to as our planning estimates. And by structural balance, we mean on this slide, we are just comparing revenues in that biennium to expenditures in that biennium, without including the impacts of dollars carrying forward or changes in the reserve balances. Current projections do show structural balance in both biennium, with the reserve projections exceeding spending projections by $379 million in 20 and 21. That $375 million structural balance number shows the amount of the budgetary balance that is actually due to revenues exceeding expenditures in this biennium. The remainder of the $1.513 billion that we have as a budgetary balance, so more than $1.1 billion, is what is due to dollars carrying forward from the previous biennium. It's also important to note that with this forecast, we continue to project a structural balance in FY 22-23, with revenues exceeding expenditures by $465 million. This chart also shows the annualized rate of growth in revenues compared to expenditures into 22-23, with the annual rate of growth for revenue projected to exceed spending growth by 0.1% annually. At the bottom of this slide, we also include an estimate of inflation for fiscal years 22 and 23. This is to give a sense of the cost pressures that exist into the planning years. Inflation is generally not included in the expenditure estimates in the forecast for years where we have not yet set a budget. The only places where inflation is reflected is in forecast programs where there is an inflationary component in the formula or where the formula is based on actual costs. Examples include property tax refund payments, special education payments, a portion of our healthcare payments, and debt service. The $1.119 billion that's reflected on this slide as the inflation estimate for 22 and 23 is an estimate of CPI inflation, consumer price index inflation, applied to all the expenditures that do not have some inflationary factor already built into a formula or are based on cost. Turning to the next slide. This slide shows the changes in the reserves that are currently projected into fiscal years 22 and 23. Commissioner Frans mentioned earlier that in the current biennium, our budget reserve is at the target of $2.359 billion, which is reflected in the first column on the chart. You can also see that the budget reserve declines in fiscal years 22 and 23 by $491 million. This change is due to a law that was passed last session that reduces the reserve by $491 million at the start of fiscal year 22. And this was done to ensure the planning estimates in 22 and 23 were balanced at the end of last session. So even though we are currently at the reserve target, the reserve balance is scheduled to be reduced at the beginning of the next biennium. Also reflected on this slide is the stadium reserve. And the stadium reserve line shows the reserve is projected to grow from a projected $130 million in FY 2021 to $263 million by the end of fiscal year 23. This growth of $133 million is due to continued increases in projected gambling revenues, along with the fact that beginning in fiscal year 21, the state begins to retain sales tax from the city of Minneapolis to cover the payments that the state remits on their behalf for stadium obligations. So at that time, revenues to the stadium reserve increased by approximately $17 million per year. Now I will pass it back to Commissioner Frans.
Thank you. I just wanted to follow up a little bit and mention two issues before we open it up for questions. The first one goes back to the budget reserve that Budget Director Reitan just mentioned. We wanted to give you a visual of what happens in 22 when the $491 million is slated to be taken out of the reserve and placed to the bottom line. One of the key issues that we talk about to the rating agencies and everyone who will listen to us is that we want to maintain adequate revenues, we want to control our spending, and we want to make sure that we preserve the budget reserve in terms of the budget, the stable budget outlook. Now, our budget reserve, as we mentioned, is currently full, but the governor's top priority this session, as Budget Director Reitan described, was to take this $491 million out of our current assets or our current surplus and use that to restore to the budget reserve account. With today's forecast, we continue to have a full budget balance, and we want to recommend that we restore that for the budget reserve. Maintaining an adequate budget reserve reduces the need for large immediate spending cuts or tax increases during an economic downturn. This gives Minnesota time to adjust and consider other options when needed services in the face of declining revenues are needed. And lastly, I just want to bring back another slide and talk a little bit more about the inflation number. We all know that inflation is real, and each year costs go up due to building costs, labor costs, energy costs. But when MMB estimates its future projected spending in the forecast, we, by law, cannot factor in inflation except in the specific cases that Budget Director Reitan mentioned. So what does this mean? It means by not factoring in inflation, the spending balance in the next biennium does not include the true cost of maintaining the current level of existing services for Minnesotans. We estimate that the next biennium spending forecast does not account for about $1.1 billion in anticipated inflationary costs. Cost pressures are real, and we all need to keep this in mind as we make budget decisions to ensure that we maintain long-term fiscal stability. For example, each year costs rise for school districts. The cost for classroom teachers and support staff grows, the cost to operate the facilities grow, and transportation costs grow. However, due to our current law, the state education formula does not specifically include anticipated inflationary costs in the spending forecast. Therefore, the forecast projections for 22 and 23 assume no increase in the basic per pupil dollar amount for E-12 schools for inflation. As a former small business owner, I needed to forecast for the growing cost of parts and labor every year because it made economic sense, and it was also smart financial planning. As you read through the forecast book, as I know each one of you will in detail, the Council of Economic Advisors has, since 2003, recommended including inflation in our spending forecast, and I look forward to continuing this discussion in the future. So as we conclude our forecast presentation today, this slide doesn't depict how I look on skis, but it does show that if you're skiing and you maintain balance and you keep going steady, we know how to get from point A to point B by being fiscally smart and maintaining a stable outlook. Steadiness in our fiscal management, along with this stable economic outlook, will allow us to be thoughtful in planning and provide predictability to the businesses that continue to invest in our state. As part of our recommendation for budget stability, we recommend restoring the $491 million to the budget reserve amount. And to improve our financial management, we recommend considering the Council's recommendation to account for inflation in our spending forecast.
Though, if these numbers are 20 days old, a lot has happened on coronavirus in 20 days.
I would just say these numbers always have an asterisk on them. So tomorrow these numbers are going to change, all of them in some degree or not. And clearly the key for us is to provide a baseline. So what we're trying to do with the forecast is give our policymakers in the state of Minnesota a glimpse twice a year in terms of how the economy is working in Minnesota and around the country, but also how is our budget responding and how are we working in our budget to take that into account. So this is not unusual, and clearly the daily amount of news is unusual in this situation, but every forecast has forecast risks. You go back to that page, and there are a number of different risks that could change tomorrow, depending upon what happens.
If you would recommend to, say, a decision maker like a governor, as to how much of this to spend in a supplemental budget? I'm not looking for a specific number, but what's a range?
Well, if I had that opportunity to advise the governor, I would suggest, I'm kind of a broken record on this. I don't think my advice has ever really changed in the last, I guess I'm in my 6th year now of doing this, and that is be cautious. Remember, there are 16 months left in this biennium. So these numbers, the $1.5 billion we talked about as a surplus, that's all projected revenue that's coming in, we hope, but it's projected to come in. So I've always cautioned about making assumptions about, especially the long term, and to be very cautious about what's ongoing revenue, what is one-time revenue, as I'll call her Dr. Reitan because she really is at a PhD level in what she does here. What she mentioned was that the $1.1 billion or the $1.5 billion that we have for this biennium is a carryover from the prior biennium. So, we know that the structural balance shows us how much ongoing revenues we have. And my advice has always been to always be careful and monitor that, and to use resources wisely, to be careful about taking on expensive, long-term budget opportunities at this time, especially when we're at the longest recovery in the history of the United States. We don't know how much longer that's going to go. We already have a potential slowdown in the forecast in 22 or 23, 24, 25, 23, 22. And so the key is be cautious. And I'm just not prepared to give a range yet because I think, the unfolding events of the coronavirus, COVID-19, is another issue that you just want to be careful about. The inflationary issue, make sure you realize we don't really have as much money as a surplus might suggest. So there are a number of areas that I would suggest to be cautious, but I pretty much always say that no matter what the situation is.
You're going to have to in less than a week.
Yes.
What happens between now and a week that makes you have a number but not now?
A lot of work. Yes.
Commissioner, we're in a we're in a bonding session. So how does the effect on the debt capacity affected by this projection?
Yeah, the debt capacity is really based on, and there's a debt capacity forecast issued today as well as the economic forecast. The debt capacity guidelines that we have shows that we're well below and well within all 3 debt guidelines. So this this forecast really shows that we continue to have the resources available to engage in a bonding bill in order to provide that debt service that we need to provide. So there's no real, if anything, this news shows that we can support a robust bonding bill without violating any of our guidelines.
What would the size of that bonding bill be that you have the capacity for?
Well, we've already issued, as you know, the $2 billion debt obligation that the governor has recommended, and that clearly fits within the guidelines. So that's what we've recommended, and I don't see any reason why we would change that at this time.
Setting aside the uncertainties we've already talked about and looking at this as a kind of a measure against the budget, the bigger budget, it seems like a fairly stand-pat forecast. Not a lot has moved.
I agree. In fact, we remarked, and Dr. Kalombokidis showed you the GDP slide that showed very, very small, only really 1 year that changed. So this, we've been remarking the last several weeks as we've been working on this about how unchanged this is. A really big variable is, of course, the coronavirus issue that's popped up. But beyond that, this has been a very, what's the word I want to use? Very stable situation. And so it's nice to have that opportunity. And, sometimes we see big changes because, the moving parts are there. But here, now don't get me wrong, there are a lot of moving parts and a lot of adjustments we've made here and there. But when they all added up to a 0.2% change in revenue and a 0.2 change in expenditures, that's a pretty small change.
Changes in labor and employment, if I could follow up on that one. It didn't seem as sunny as last time. Last time people were moving here. The employment and labor numbers seemed more positive than this time, with concerns about slow employment growth. Is that true?
Yeah, we've long known that employment growth was going to slow in Minnesota because our labor force growth has been projected to slow. And so in this outlook, employment growth does slow, and going forward, so it appears that labor force growth is limiting our ability to add jobs. And the reason I say that is because we appear to still have very strong demand for labor. Businesses are still trying to hire. They're hiring and they're trying to hire. But the reason that they're not able to close those open positions is because the labor force growth is not there. And so that is limiting it. It's not just true at Minnesota. It's been true for the United States as well. U.S. employment growth has been slowing, but Minnesota, as you know, has been kind of ahead of the curve, ahead of the expansion. We recovered the jobs lost from the Great Recession ahead of the United States, and I think that our employment growth slowed ahead of the United States.
In comparison to the rest of the Midwest, how are we doing broadly speaking?
So I don't know about employment growth in the rest of the Midwest. In terms of population growth, we are growing faster than other parts of the Midwest. When I said that our labor force participation rate is very high relative to other states, and second, the state that's ahead of us is Iowa. So they have a very high labor force participation rate as well.
Big picture on the forecast, last time it looked like we were outperforming our region. Are we big picture still outperforming the whole region?
So in the big picture way that we are outperforming the region is that looking at 10 years of population growth, that we are growing faster than the rest of the Midwest. The other way that we were outperforming the Midwest is that we had 2 years of positive net, now 3 years of positive net domestic migration. And that reversed a 15-year trend and made us an outlier in the Midwest.
Commissioner, could I ask you to return the podium? You, I presumably have seen the supplemental budget requests that are probably raining down on you. I'm wondering if this is the origin story for the resurrection of Omnibus Prime.
No.
How can you be confident in that?
Well, I think one of the key issue about the Omnibus Prime, I think both the leaders that I've talked to and the governor have all been concerned about, this is a supplemental budget year. And I think everyone takes that fairly seriously. I mean, obviously it's a year where we consider a larger bonding bill than usual, and that's going to be a big focus. But when you go beyond that, I think from our point of view, when you look at what needs to be done this year, it really is what are the issues that really have a real concern about taking care of now that can't wait for the next biennial budget. And I think those are the governor is going to be looking at those prominent issues that need, whether they're safety or education issues that need to be addressed now and they cannot wait. That's the nature of a lot of what the governor is going to be focused on. As Commissioner Schnell talked about, these safety issues at the Department of Corrections. Those are the kinds of things that we can't wait on and we need to move on. So I think we're going to be focused on those kinds of issues. That's why I don't think it'll explode into a large Omnibus Prime budget bill.
On that, you mentioned the carryover money from 1819. Is that mostly or entirely because of the veto of that previous supplemental budget bill, carryover funds?
Well, there's parts of it that certainly come from that, but it's really a result of leaving money on the bottom line at the end of session last year. I mean, part of the budget deal was to do that, and we, as we mentioned, we used $491 million out of the reserve to make that balance work in 22 and 23. And so now we realize, based on the recovery of our revenues, we have enough resources to pay that back. So that's partly why that's important to us. I think we have someone you might like to have more questions from, and that would be.
Projecting the economic impact given how big of a trading partner China is with the state?
Well, that's a good point. So the question about maintaining constant updates and information in the face of changing, I mean, I think that's something we've already talked about, the need to take in information. And when, one of the things we watch are revenues. And so, I mean, it's going to take a while for any effect to cut into our monthly revenues. But one of the things we'll do is monitor what the information we have. We'll monitor our IHS consultants, and we will make sure we pass on that information to the governor and other policymakers. So we will, not sit back and wait till November. If there's information we think you need, then we can pass on. Thank you all very much.